The world of single family rentals is kind of scattered. I mean, you've got a mom and pop landlord that maybe owns a 30, 40-year-old house, and you don't have the amenities of a multifamily community with that. And you certainly don't have like the finish out of a brand new home. It's hard to get that kind of quality in a rental home. And we're trying to give our resident kind of the best of both worlds between a Class A apartment community and a suburban rental home.
For a lot of the investors out there, you guys know I've been investing and a big fan in multifamily for a lot of my career as an investor. Why? Because it is just a great asset class. Well, over the last couple of years, a new subset of multifamily investing has come out called build to rent, or BTR for short. And I have been an absolute in love with this class, following it for years. I've been to a lot of investors at the institutional level talking about it. And I'm very excited to have Ryan Watts with Red River Development in the studio today to come talk about the BTR overview and also his story. Welcome, Ryan.
Thanks, Chris. I appreciate it. Glad to be here.
Yeah. So one of the reasons I always, as an investor, I always just look at, hey, where are the big trends? Hey, what's the next big trend? Build to rent is one of the biggest trends, I think, in real estate. So start off and tell us about yourself and Red River, please.
Yeah, happy to. No, thank you. I would second what you said. We're believers, obviously, and we built this business to invest behind build to rent. And so, jumping back in time, around 2018, 2019, my partner, Jay Dempsey and Stephen Watts and I were talking about BTR as an asset class, and the fact that it was, a fast emerging kind of subsegment within multifamily, something that we really thought had a lot of legs. And we'd seen this get, developed in markets like Phoenix, which was one of the first markets where it really hit. We saw it in Dallas. We're based in Dallas. And so, after kind of continuing to watch it and talk about it, we said, hey, gosh, this is something we really believe in, want to invest behind. And then, a sequence of things happened. I sold a company in 2020. And then Jay, conversely, had been investing in the senior living space, built a large senior living business called Civitas Senior Living, still a large business. And he'd seen the success that specifically his cottage product in his senior communities was having. And that was another sort of indication that we had. And so, long story short, I sold my company. Jay and I had been investing in some of Stephen's deals in Oklahoma, in Tulsa, Oklahoma, where we all grew up. And Stephen's got a background in kind of construction and project management, multifamily development. And so, we locked arms in early 2020 and said, hey, let's build a business to really invest behind build to rent. And that was Red River Development. And so fast forward to today, we've got about 1,500 units under management, about 400 million in AUM. And we've built a BTR brand called Trulo Homes.
And that's your tenant facing.
Yeah, that's right. That's our resident facing brand. That's right. It's an integrated business in the sense that, we develop it, but we also manage it. We manage it ourselves. And so Trulo is the brand we've built that our management team manages under. And we've got 5 BTR communities today. We have one in Tulsa, Oklahoma, one in Oklahoma City, one in Kansas City, one in Bentonville, Arkansas, and Indianapolis. So
now paint us a picture for what a one looks like, because I always describe it as a horizontal apartment building. Mm-hmm. It's essentially subdivision. How would you describe it so that a newer listener or a newer investor can understand it?
Yeah, that's a great question. That's an apt description. There are different kind of subsegments even within BTR, but our product type is primarily horizontal multifamily. You also hear it called cottage style housing. So it's 10, 11 units to the acre. And we have, in our communities, we have 1, 2, and 3 bedroom homes. And we're trying to give our resident kind of the best of both worlds between a Class A apartment community and a suburban rental home. So on the apartment side, we've got a large clubhouse, we've got a well-equipped fitness center, we've got a resort-style pool, dog parks, community spaces, sometimes playgrounds, sometimes pickleball, nice amenity set. It's a gated community. Our residents typically are parking either in covered parking. We also have surface parking and then garage parking. The covered and the garage are for rent. And then our residents are walking out of their vehicle and walking to their front door. And so each home has its own private backyard, high ceilings, usually 10-foot ceilings. They're unattached, and so it gives residents something that really feels like a home. And I think that's the kind of the magic of it is they're getting a little bit of the best of both worlds between that Class A apartment community and the suburban rental home.
Great. And then talk about the trends behind here, because I always like to kind of start like trends, and because the trend is your friend, right?
Sure.
Why is BTR so popular right now?
Yeah, it's a great question. Number of reasons. Number one, we're seeing probably the biggest driver is the rising cost of housing. Our rents on average are about $2 a foot, give or take. Chunk rents around $2,000 a month. And so if you look at what does it cost to own a median priced home right now, it's about $3,000 a month. And, that's not even talking about, maintenance costs and some of the other things that just come along with home ownership that are kind of hidden expenses. But so I think that's a huge driver. Also, you've got, I think, a changing demographics in the sense that, people like to rent. I mean, they like the flexibility of rent. There's a lot of people that could own a home, could afford to own a home, but might prefer to rent. And we see that a lot in our communities. We've got a lot of empty nesters, folks that raised a family in a suburban community that had a big house. They're ready to unload that and sell the house and be able to be in a position where they can have a community where everything's taken care of. You've got maintenance taken care of. You don't have to worry about any of that. You can lock it and leave it and travel and so forth. So that's a big driver from a demographic standpoint.
I never thought about the empty nesters. It makes sense. I've always, a lot of times, like a lot of people in my 20s, I lived in apartment buildings in downtown areas, and get in my 30s, start a family, get a dog, get a house, move out to the suburbs. I always envisioned a lot of the residents being in that like the younger demographic. So is it both? Or?
It's both. I mean, that's still a very large cohort, and sometimes is the biggest, but other times the empty nesters can even be bigger in a community. It just depends on the location. But you're always going to see the other largest demographic for our product type is folks that are transitioning out of apartments that maybe they've got a pet, maybe they are starting a family, but they're tired of apartment living. They don't want kind of people above them to blow them and some of the hassles that come with living in an apartment. But they're not quite ready to buy a house yet. And so for that demographic, this is a great product type too. And we see a lot of those folks.
Did the issues from COVID, where COVID, pushed a lot of people out of downtowns. Now, build to rent was already happening before COVID happened, but did COVID accelerate people moving from downtown areas more to these suburban communities?
I think so. Yeah, I think it did, and we've certainly seen that. Obviously, there's been a lot of migration when you think about migration in the United States. Oftentimes transitioning, from the coasts to the middle of the country. So we've certainly seen that in a lot of the markets that we invest in. And we also see people that are just looking for more space. COVID, obviously a huge driver. If you're in a multi-story apartment building and you've got people all around you, especially when COVID was at its height, I mean, people were just looking to hightail it out of that environment. And so this is a great option, certainly for folks that want more space, that want their own space, and they don't have to be interacting with other residents in hallways and elevators and common areas like you do in a multifamily community.
Now, what about like in terms of just rents and rent growth? Because I've invested a lot in multifamily value add, Class B, Class C type properties, and Class A. A lot of times last year or so, rents have been, flat, or, even trending down in some markets. And these is, horizontal Class A multifamily. What's the rent like you're seeing in these units compared to like your traditional, vertical Class A downtown? Yeah, sure.
So I would say as a general rule, we typically get 30 to 40% premiums over Class A suburban new built multifamily in an area.
Really?
We do. Yeah, we do.
I like that.
Absolutely. Yeah, no, absolutely. Yeah. It's proven out. We've seen that across, all 5 of our communities.
Okay.
And even beyond that, there's, John Burns has done a lot of research on this and has a lot of data, kind of identifying what that BTR premium is, but we've certainly seen it for ourselves as we've delivered this product. And And I think that just goes to show that people see the value, our residents see the value and are willing to pay that premium to have something that lives like a home.
Okay.
Yeah.
And then in terms of how you select the site, how do you go about doing that?
So, for us, we have made a focus of being a first mover or a fast mover in what we think are strong secondary markets. And so I mentioned the markets we're in. We believe that about all of those markets, that those are strong secondary markets. And oftentimes what you've seen, I think, with a lot of the institutional capital that was just, I would say in 2020 to 22, I think it started to taper off in 23, but everybody was kind of piling into the top 10 markets, right? And so, the Dallas, the Austins, the Phoenix, those markets. And I think you touched on rents earlier, that's where you're seeing a lot of downward pressure on rents. And because there is so much supply that has hit there. And so I'll say we looked at the landscape and said, hey, if we're a first mover in a place like Tulsa, Oklahoma, or Bentonville, Arkansas, or Kansas City, where we don't see a ton of investment and a lot of people piling in. We love those markets. We believe in them. They've got good steady growth. Now, it's not the white hot growth of a Phoenix, but great places to invest and not as much competition. And so we've seen that strategy bear out and really play well today, where we've got a differentiated product and we're really able to command great rent premiums in terms of seeing on our community in Tulsa, we're seeing 8 to 10% increases when it comes to lease renewals and lease turnovers. And so
on renewals, you're seeing that much?
We are. Yeah, we are. Yeah. And I think it jumps back to the fact that residents in this area, they recognize that this is a differentiated product. It's unique. And there's really not anything like it in that community, at least certainly not in the submarket we're in. And so I think that's what really allows more movement in rents, certainly than you're seeing in a lot of traditional multi.
So I'm assuming you have pretty low vacancy at your communities?
Yeah. So our community in Tulsa was the first one we developed. That's in a suburb of Tulsa called Jenks. And we've stayed above 95% the whole time ever since we delivered that and got it stabilized. So, and certainly saw it lease up quickly. So it's performed great, certainly exceeded our expectations.
And we're actually going to record, we have another podcast that'll be coming out. We're going to actually do a case study on the Jenks community talked about. So I'm excited to go on a deep dive on there because you've already shared some spreadsheets with me on that. And they are like, we'll do a deep dive in that specific community. So as you mentioned that in this, investors, check out their other episode for more details on there. But keep talking to me about kind of like the macro overview of build to rent.
Again, I think big drivers we touched on earlier. Obviously, the unaffordability, lack of affordability of home ownership, and we build far fewer starter homes today in this environment that we're in now than we used to, jumping back 30, 40, 50 years. A lot of that is just the economics of construction and cost of land, and you're just seeing that higher price point for homes, which leads to a $3,000 a month plus kind of mortgage payment. We touched on migration. We touched on folks moving from the coasts into the middle of the country. Beyond that, we're also seeing just in these suburban communities a lot of folks that are looking for great school districts and a lot of things that you just traditionally look for in the suburbs. But where it was hard for a lot of folks, I think, is just the world of single family rentals is kind of scattered. I mean, you've got a mom and pop landlord that maybe owns a older kind of 30, 40-year-old house, and you don't have the amenities of a multifamily community with that. And you certainly don't have like the finish out of a brand new home. It's hard to get that kind of quality in a rental home, and you just don't see much of it. So
you talk about that made me think of like two things. One of the very first presentations I went to is actually through John Burns. Two things this investor talked about was he was like he had never seen capital fly so quickly to an asset class, talking like institutional level. The second thing is he goes, the quality and the efficiency that you get for property, for managing all these properties. Hey, they're all new build stuff, all built about the same. And then the way to have, sensors in the roof to check for water leakage, or he read off all these, all these tasks, all these things they have. And I own a bunch of rental families here in Denver. I was like, wow. I'm jealous. I want that because I have stuff built in the 1960s and something happens I don't know about until 3 days later.
Yeah.
So like what type of what do you build in the properties to help you like manage them better? Are there like sensors or that might be the best example. How do you get like efficiencies at scale for managing these properties?
Yeah, it's a great question. And that's part of why when we looked at this landscape, the first wave of investment that came into this space was following the financial crisis, right? And a lot of capital raised. You hear about Blackstone investing a lot in buying scattered site single family rentals, and put a lot of money to work and built some great businesses that have been tremendously successful doing that. But the thing that we saw also was like, hey, it's hard to manage. That, and we knew we wanted to manage, so we said, look, we think we're better to do purpose built for rent and build this stuff from the ground up because you get the, to your point, you get the efficiencies of having an on-site leasing team. Our communities typically have anywhere from 3 to 5 full-time employees depending on, how large the community is and kind of also at what stage. Sometimes after a lease up will flex down a little bit, but, you can have somebody who's full-time on-site maintenance. And I mean, that's a great, and we do at every community. That's a great amenity and a great benefit for our residents that somebody's always there on call to take care of any maintenance issues, and that's hard to do if you've got a scattered rental portfolio. The same's true with having just on-site leasing and somebody manning a clubhouse and somebody that, if you've got an issue or something you want to talk about, you just, you can pop in there and do that. So those are some of the kind of obvious benefits of the scale. And then also, the consistency of materials, consistency of finish out, when things get damaged, when things need to be replaced, paint colors, things like that. I mean, there's, it's very consistent, right? That you're not going to find that in a scattered rental portfolio of all different kinds of construction, different vintages and so forth. You're having to get a lot more creative and versus being able to buy things in bulk and be able to replace things, that way.
And they're all probably just sitting in a warehouse or a storage shed.
That's right. Yeah.
Somewhere close by.
We have one on site, and there's a lot of that stuff gets fixed very quickly.
Yeah. All right. So give me a high level on the rents you estimated for Jenks, that build rent community in Oklahoma, and then where it actually came out at. Because this made my jaw drop. Yeah.
So we had a market study. In fact, John Barnes did it. And we did all of our underwriting and said, okay, their recommended rents were on average across the units, a chunk rent basis of $1,700 a month. And so that's what we had in our financial model. And, as we started to deliver the homes, we saw there was just a lot more demand than we had expected. And rents had moved up in some of the suburban communities, even the garden style stuff. So we were able to push rents. We ended up 20% higher than what we underwrote on rents. And then, as I mentioned, we've still seen that continue to grow when it comes to lease renewals and lease turnovers. So I think that's just jumping back to, this is a differentiated product. It's not just another suburban garden style, multifamily community. It's something different. And I think the market recognizes that.
And then from a high level, walk me through just on the investor side, because, I've invested in a couple build to rent deals over the years, really looking forward to some of the stuff you guys have in your pipeline for just, me as an investor. Walk me through just the big picture on the capital structure, the timeline, and just the big picture of how you get the land, the cost, the timeline, and how you deliver it.
Most of our communities are around 200 homes. As an example, we've got a community that we're developing here shortly. We actually have 2 shovel-ready sites, one in Waco, Texas, one in Centerville, Ohio. And as an example, our Waco project's about $55.5 million total capitalization project. That's 206 units. Typically, we're financing 65% of that cost, 60 to 65%. It depends on the deal, but to date, we've been primarily 65% loan to cost. So we've got a 65% bank loan that covers that part of the stack. And then typically we're raising around $20 million in equity.
Okay.
And so 35% equity. And that's our basic capital structure.
Okay. And then timeline from, hey, they're ready, they're shovel ready. What's the timeline from the first piece of dirt move to when the first resident is moving in? Yeah,
we are looking at about 14 months from the time we first put a shovel in the ground to when we're delivering the first phase of homes. And that phase one is going to typically come with our finished clubhouse, 1 or 2 model units, depending on the community, and then 15 to 20 homes.
How many phases are there usually in one of your communities?
Yeah, it varies. I would say, can be anywhere from 6 to 10, depending on the size of the community. And exactly how our GC lays it out. But so we're building this in phases. So let's say month 14, we deliver that first phase. They're going to continue working on each phase, and they kind of work it, front to back typically. So we're cordoning off and sectioning off the areas that are under construction and trying to kind of keep that, as removed as we can from the residents that are living there. And then we typically see us wrap up around month 23.
Do you have the multiple phases? That's just so, hey, you can get the CO for the phase one, get residents in there and just start. That's
exactly right. Yeah, I mean,
okay.
that's the from a financial standpoint, it works great because you start to bring in revenue in month 14, and it helps get to stabilization faster, and it helps get to cash flow faster because our base strategy is, hey, let's lease this up. Let's refinance our construction debt and put fixed rate financing on it typically, and then start making distributions to our investors.
Because that was one of the things where I was just so excited when I first started getting BTR a couple of years ago. If in a vertical apartment building, everything has to be completed and done, and the CO for the whole building before the first resident moves in.
Mm-hmm.
And then your communities, you have the first unit, the first phase, get the CO on there, great, residents start moving in.
That's right. Yeah. Yeah, it's a great advantage.
So from general terms of investment for an LP, because I'm always looking at this for myself. Hey, I go out there, I get to invest in one of your deals.
Mm-hmm.
What's the general IRR or distribution look like? Paint me the picture, just how the financial model looks.
Yeah, sure. So at a high level, we are looking to generate, 25%, around 25% net IRRs and 2x multiples. So that's what we're looking to deliver to our investors. And the profile of that, as I mentioned, once we hit stabilization, and let's say stabilization occurs around month 30, we are looking to refinance out of the construction debt, begin making distributions, and that's typically going to be a high single digit, low double digit kind of cash on cash yield. And then we're going to continue to try to grow rents and grow NOI and position the property to sell, let's say in year 5. That's typically how we would model.
Okay, so about a 5-year life cycle.
That's right.
Okay, and then the end buyer, is that typically an institution buying?
That's right. Yeah.
Okay.
Yeah. The scale of these assets makes it very attractive for an institutional investor, strategic investor as well. There's a number of public companies that are active in this space. And so, it's very much an institutional asset class.
And then I want to rewind here because I glossed over some of your background and your partner's background.
Yeah.
But I know you said, you built a great business, had an exit, 4 or 5 years ago,
Mm-hmm.
but you'd been investing in real estate for most of your adult career, right?
Yeah. If you jump all the way back, really, that was the first thing I ever did in business. I was in college and was always attracted to real estate, and decided, hey, I wanted to go out and buy some rental property, which I ended up at one point I had, 4 different properties and, what did I have? Probably 8 units. So I was landlording on my own and mowing the grass and, dealing with tenants and doing all of it. So I've always loved real estate, but, once I graduated, I got into the oil and gas industry and then very quickly after that, started my first company. And so that brought me back to Dallas and, led to a 15-year run where I was very focused in the oil and gas business and didn't have a lot of space for real estate other than just some passive stuff. Some of what I mentioned where we were, Jay and I were investing with Steven previously, but,
Yep.
And a few other things, but yeah, it's great to come back to it. And it's great. It's been, a really fun business to build and something obviously we really believe in. And we, love the product, love what we're offering here to our residents. And it's been fun to do it, with Jay and Steven and the rest of our team, certainly.
And then kind of looking forward at the next 5 to 10 years.
Yeah.
What's that look like for the BTR investment space?
Yeah. So, we're at an interesting point now. You mentioned earlier, a ton of capital flowing in 20 to 22, started to taper off in 23. with the run up in interest rates, you've just seen a lot of that capital freeze as people are waiting to see, hey, what are exit caps? Well, all of these kind of questions that come with an interest rate move like that. And so, we're flattening out. Looks like we may have probably less cuts than originally thought this year, but maybe we get one. But at any rate, the flow of capital into development, I would say from an institutional level, and our investors to date have been primarily institutional investors, has really tapered off because the investment du jour for the real estate fund today is, hey, let's go find distress. We want to go find guys that have, bad capital stacks that got over levered, and we're going to, they're looking for blood in the water and trying to buy below replacement cost. And then secondarily, there's a lot of kind of shift to credit type stuff and pref equity and things like that. You hear a lot about as well, is how a lot of these real estate private equity guys have positioned their portfolios, which you understand. But I would say the opportunity for development, and certainly in BTR, is very, very strong. And we've certainly seen it bear out in our communities in terms of how these communities are performing. So the good thing is, I think it's created an opportunity for the high net worth investor, the family office investor, to have an opportunity to access what is mainly been gobbled up by institutional investors here to date, because the scale's pretty large. But we see that as an opportunity for the savvy investor that says, hey, look, here's an asset class that's really working, that is, if we're honest, is still in the very, very early innings of BTR as an asset class, being that it's really only 5 years old, maybe it's 7 years old, depending on where you sort of really peg the start of it. So I think it's got a ton of room to run.
I do too. So I know I say this with a smile on my face, so hopefully take it the right way. I know the institutional capital drying up has probably created some headaches for you guys and your partners. But for me as a little investor, I'm excited because I actually get the chance to invest in some deals now. Because a lot of books in the past are just like, you're too small. We don't want to bother with you. We're getting a $100 million check from Wall Street over here. I'm like, I can't blame you. I get it. I would take that too. So I'm excited for that macro opportunity for myself, a lot of our investors, because as that trend has changed, it's created opportunities for, like I said, the small and the savvy investors as well.
Absolutely. Yeah,
cool.
I agree completely.
Ryan, this has been a great podcast. We could talk hours, but we'll do that in future podcasts to keep it succinct and on topic. So thank you so much. I'm glad you come out to the studio today.
Chris, thank you, man. I really enjoyed it and look forward to doing more.